Hello everyone, welcome back to Financial News here in Palos Heights. Today is October 24, 2022. My name is Ron Jankowski with Channel 4, and my partner is Paul Munichel, and he is my co-host from Ameriprise, and I'm going to let you take and share with us what is taking place last week. And Ameriprise is giving me some latest information as of this morning, and we'll read that after you're finished.
Great, thanks, Ron. I'm going to hit on corporate results today because that's what should be driving the market in most situations. So corporate results, they struggle right now to maintain positive year-over-year earnings per share growth. You know, the earnings release season, it gets up to full speed really this week with about 165 or really about a third of the S&P 500 companies, they're scheduled to report this week. Now, through last Friday, 20% of the index had reported their results, with 72% issuing better than expected earnings per share and 70% reporting better than expected sales. That data according to FactSet. But both numbers are slightly ahead of historical average. Now, despite the above average number of companies beating estimates, profit trends in aggregate remains weak. Through Friday, analyst consensus estimates look for total year-over-year Q3 earnings per share growth of just 1.5%. on sales growth of 8.8%. At the end of the quarter, which is September 30th, consensus estimates were looking for EPS growth of 3% on sales growth of 8.5%. Additionally, as we've noted previously, the vast majority of EPS upside comes from the energy sector alone. If we excluded this one sector, that would leave year-over-year EPS growth estimates down 4.9%. Also, forward estimates have also been declining. Consensus estimates for Q4 now look for year-over-year EPS growth of about 3% on sales growth of about 6%. At mid-year, Q4 EPS were forecast to grow by 9.4%. So you can see these numbers are declining, not going in the direction that one would hope in terms of growth. But you know, we can get you more information on the S&P 500 earnings estimates. If you're interested, obviously give me a call. We can get you the data that we use to source, you know, this information from, if it may interest you. So we got to keep watching these numbers because that is fear and greed tend to drive the stock market, but earnings and stock and company returns is really what should be, but we'll see.
And if you're going to invest in, if it's a small-time investor wants to get into the stock market, they really need some guidance on this.
Not even all levels of investors need guidance on when, you know, timing is very difficult in the stock market, but it's very important, you know, so.
Well, Ameriprise has shared this following information that I received this morning. U.S. stock index futures are modestly higher this morning after the S&P 500 posted its best week, a plus 4.8% since June.
We needed that week last week. It was nice to get a positive uptick. Now, does that continue? Do we give it back this week? That's yet to be seen. Earnings is going to have something to do with that.
The impact on this, right? Markets in Asia closed mixed, but the big standout was Hong Kong down 6% following China's Party Congress results. And Treasury yields are lower with a 10-year at 4.20% following the 12 straight weeks of yield gains.
Yields been going up. We got our first little bit of a pullback. I wouldn't even call it a pullback. It just went down slightly. Again, 1 week doesn't cause a trend. We've got to wait and see.
Yeah, exactly. And of course, the information on Bitcoin futures are down 0.6%. Gold is down 0.3%. And WTI crude is down 1.3%.
I know you like that.
Well, I sure do, because that brings our gasoline prices down, hopefully. And year-to-date index returns, S&P 500 minus 20%, Dow Jones minus 13%, NASDAQ minus 30%. Any comments, Paul?
Still significant losses on the year, but a lot better after last week than what we reported. I mean, so we're starting to come out of this, maybe. At least last week's indication made the year-to-date numbers look a little bit better,
Hopefully we have a good fourth quarter.
hopefully.
Okay, stay with us. We'll be right back with our show called Your Money. Paul usually has a great, interesting topic. And stay with us. We'll see you in a little bit. And we're back with Your Money. And let's listen to Paul talk about the art of rebalancing your portfolio. It's very, very interesting, and it's imperative that you do take another look periodically. I'm sure you have clients that you need to talk to quarterly or annually, whatever it is. But depending on their expectations, they do need to rebalance it, I'm sure.
They do, and rebalancing is something you and I have talked about on the show before, but it is important and it's worth noting some of the more. I'm going to give you a few steps to consider when you're rebalancing today. So, when you are striving for balance, it's a principle that applies to investing just as it does to all other areas of your life. When one area gets out of proportion, it can disrupt your financial goals. Now, there are, however, principal strategies or practical strategies to keep your portfolio in balance and your long-term goals on track. So in today's show, we're going to discuss the basic steps or the basic rules of not just why you should consider rebalancing your portfolio, but when and how to think about doing it. So let's start with the most basic question. Why rebalance your portfolio? The chief purpose of rebalancing is to ensure your portfolio remains allocated according to your long-term financial goals. Now, over the last 2 years, the stock market has experienced periods of volatility. Inflation, supply chain problems, global conflicts, and all other factors continue to affect stock market values. More downside volatility is expected in contrast to the pre-pandemic stock market boom. Now, under these uncertain conditions, it's especially important to review your portfolio and rebalance your assets as appropriate for you. So today, let's go over some tips to help you achieve a balanced portfolio. One tip, assess the big picture. So ideally, your portfolio is some combination of the 4 asset classes: stocks, bonds, cash, and in some cases, alternatives. Too much of your portfolio in stocks may expose you to too much risk. Treasury bonds and other reliable and municipal and corporate bonds can potentially help insulate your portfolio during times of volatility. While alternatives are non-traditional investments that could include everything from precious metals to real estate to cryptocurrencies and maybe even carbon credits. Now, many alternative investments are considered highly speculative, and they do come with greater risk. So they will typically make up a smaller portion of your portfolio. It's smart to have a certain amount of cash on hand for emergencies. However, there's no reason to keep excess amounts of cash in low interest-bearing accounts if you can get better results in higher yielding investments. Now, your financial advisor can help you determine the ideal mix or distribution of assets across these groups. Second point to consider is to diversify to insulate your portfolio. Now, diversification is a strategy of owning a variety of investments within these asset classes we talked about. The goal is to spread your risk across stocks or bonds in different sectors, industries, and even graphical regions. 3, buy and sell strategically. So your financial advisor can help you evaluate stock returns and potentially weed out losers. You may also be advised to reduce your position in a high-performing investment if your portfolio is overweighted. Selling higher-performing investments that are not in tax-deferred accounts, such as your IRA, they may result in capital gains taxes. So if you sell an asset at a loss, you may be able to use the loss to offset your capital gains, potentially to reduce your tax obligation. Now this is called a tax loss harvesting. You're going to want to speak with your tax advisor for more details on that. Next, revisit your portfolio periodically. Let your financial advisor know about life events that may alter your risk profile. Marriage, divorce, job advancement, and retirement. These and other life changes can affect your investment goals. At a minimum, schedule an annual review with your financial advisor to discuss rebalancing your needs. And as always, consider professional advice. Resist the temptation to manage your portfolio on your own without the advice of a financial professional. A trusted financial advisor with fiduciary responsibility can help you select suitable investments to meet your investing goals. They can access tools and apply market insights to help you improve your position. Also, always consult with your tax professional regarding the tax consequences of your investment activity before you take any action on your portfolio. And as always, if you have a financial advisor you're working with, that is great. But if you're looking to work with someone or want a second opinion, you can always give me a call at 708-226-3412.
And you should also be contacting your tax advisor as well, and in conjunction with a advisor on, as you are offering, the two work together.
Exactly. Especially as we approach the end of the year,
Yep.
It's important to make sure that your tax situation is where you want it to be.
Okay, thank you, Paul. For Paul Munichel with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Pale Sites, we wish you good investment day.